This is Market Sense. Let's get into your Asian markets now, which were mixed heading into the weekend Friday, with energy firms again taking a hit from a plunge in oil prices. That's while investors look ahead to the release of key U.S. jobs data later in the day. Now, observers said there may have been some caution setting in after a report suggesting the long-running trade talks between China and the United States had hit a snag. Now, with optimism fueled by a broadly strong earnings season began to fade, dealers are taking their cash off the table after a strong start to the year, while analysts noted that May is traditionally a weak month for equities. Subdued trading in the Far East, with the Hang Seng and Hong Kong rising 0.5% to firmly above that 30,000 point mark at 30,081. Both the Nikkei and the Shanghai Composite are both closed for public holidays. They'll only be back in action. That's next week. Over to the United States now, and U.S. stocks eased further from recent record highs on Thursday as energy shares dropped, with oil and investors digesting some of the comments from Federal Reserve Chair Jerome Powell from the previous day. Now, the Dow Jones Industrial fell around 0.5% to 26,308 points. The S&P 500 lost 0.21% to 2,917, and the Nasdaq Composite dropping 0.16% to 8,036 points. Now, the markets themselves have obviously been topsy-turvy of recent times, and things haven't necessarily gone the way they would have liked, considering just how markets have been when taking in the growth story of the global economy. The old share locally has been battered and bruised, but today is up on the green, and even the euro market sitting up in positive territory at midday trading thus far. So things have fared a lot better today, but it is the question of just what will happen with those jobs numbers out in the United States that may begin to move markets in South Africa as well a little bit differently. 185,000 new jobs are expected from that jobs report out in the United States, and the JSE should be able to move in that trajectory. And as you can tell, that market moving up today, now firmly testing that 59,000 point mark, and all it has to do is gain just over 1% for this year to make up all of the gains that were lost in 2018. We're rooting for it, of course, and hoping that things happen on that front. The resource stocks and the counters here as well going up in a positive territory, so it's an all-round good day by the seams of things as well. That weakening in the currency may certainly have helped somewhat when it comes to these counters. One takes a look at the commodity picture. Platinum is the only one headed higher. We're very thankful for gold, for the oil price rather, going down and edging towards that $70 a barrel mark, having hit that $75 a barrel mark. 12.3 million barrels per day. That's how much oil the United States now produces, and that has been a key figure of late. And into your currency picture, 14.53 against the US dollar, a weakening in South Africa's currency on that front, with the British pound at 18.88 and 16.20 now for a euro. Let's unpack that market picture now and unpack exactly what has been happening thus far when things have been perhaps moving somewhat. Yes, we have that jobs data out of the United States, and that will be quite critical and key to how markets perform. Warwick Lucas from Galileo Capital joins us now as we unpack that market picture. Warwick, thank you so much for the time. It's been perhaps a topsy-turvy time for the JSE in recent weeks, rather. And perhaps, let's say this week, because it's gone on 5-6 weeks of positive gains. But, last week finally not getting that mark. And this week, perhaps not too sure as to where exactly things are.
Yeah, I think a couple of factors in play there. We've seen precious metals looking a little bit softer there, trend-wise, and when that happens, well, you tend to see the rand looking weak, and the market doesn't really like that either. So yes, that's tended to put a bit of a
we did have some slightly positive data when it comes to things like PMI, even China seemingly getting some positive growth data this week as well. Do you think the sentiment is perhaps getting a little bit better as we move on to the remainder of the year? Yes, equities have been sort of joyful, but it is May, and the old adage is you sell in May and go away. Is that ringing true, you think?
I think there's a convergence of factors here. I mean, the story of US-Chinese trade talks getting better and better is an old chestnut, and frankly, it's starting to look a little worn. We actually have to see some resolution coming through here. And while we're on the subject of trade, of course, the issue of the US versus Europe has certainly not been resolved. That's something that's a can that's been kicked down down the road, and that's a can that's got to get picked up in the second half of this year. So resolution needed there, and then of course the US now and the Fed looking at the whole issue of, well, where are interest rates going to go? And the past couple of days we've seen a more cautious tone coming through there, and again that's puts a lid on things. So all of it is a perfect convergence with that old saying of sell a man, go away.
Yeah. Look, if we had an unemployment rate of 3.8%, I think government would bite my hands off.
Yeah.
Right? The United States sitting with that 3.8% unemployment rate, expected to add 185,000 jobs in the month of April. We'll find out later today how much that figure is exactly. But clearly that economy is doing well. Why did the Fed not look to perhaps boost that economy a little bit more? Was it risks of inflation? Was it fears? What is it exactly that perhaps, didn't move the Fed to even cut interest rates in the world number one economy?
Well, I think that concern is that the level of unemployment as it is, it basically cuts into available reserves, as it were. And it means that just about any increase in economic activity will in turn lead to a sort of a wage push spiral. So typically an unemployment rate of 4% was actually considered ceiling, and we've been through that ceiling for quite some time now. Yeah. So from that point of view, I think we see the Fed on pat. I think what is getting ignored there is that to some degree workers who've basically given up in the past have actually been re-entering the economy, and that's actually been keeping some level of sustainability in the inflation versus employment numbers.
Yeah. Would you say that the fall in South Africa's currency is perhaps the biggest boost to today's trading? The resources going up 1 1/3%. Gold counters up 1%. Industrials as well, nearly 3/4% there. The rand having weakened to 14.53.
Yeah, I mean, our currency is very much a shock absorber, and I think again we're going to be looking at this for the rest of this year when we've got relatively weak GDP prognosis. I mean, our currency is probably going to be doing quite a lot of lifting.
And that's going to be a serious one to look out for when it comes to South Africa's oil prices. Well, petrol price, and if you take a look at that Brent price there, as I said a little bit earlier, $70.70 a barrel there. That's good news for it to drop, for our sake, that is. Of course, the oil exporting nations, it's a bit different. But you've got Venezuela. You've got the Iran sanctions, which officially come on board, of course. The waivers have now come to an end. You then have the United States deciding that they're going to increase their output to record highs, and you then have OPEC possibly increasing their output. Where then does the oil price go with all of that just sort of happening?
Well, yeah, I mean, it is ironic, isn't it? Sanctions on a naughty Middle Eastern country, and hey presto, the exports are now up to a record 6 million barrels per day. Sure. I mean, US exports have literally doubled in the last 2 years. It's a really, really big number there. So, of course, it's very easy for them to throw sanctions around like that. But be that as it may, that's dictated the terms. Of course, OPEC is trying to maintain a little bit of ground on pricing, but I'm not sure that there's actually a lot of space that they've got. I mean, they're in a position that the likes of Saudi and so on have to pump to keep the books balanced.
Yeah. So the question then becomes, do we trade at 70? Do we trade below 70? Is this perhaps the right range between 70 and 75? Is it perhaps a little bit lower? And I suppose the question becomes, is it a short-term play, or is it perhaps a sustained play here at these levels?
Well, I think the old chestnut as far as the US and new capacity always was that new capacity would come in over $60 a barrel and would be very profitable. But of course, with the volatility in the oil price, I think producers, particularly after the experience of the last few years, are going to look for a little bit of, shall we say, cushion. And I suspect that's what's happening there. I mean, yes, you will have seen more rigs coming in, but actually seriously investing in a new well, perhaps that's been held back just a little bit. But at levels above 75, I suspect they'll come in size.
Yeah. Okay. Quite an interesting story in itself there. Warwick, appreciate your time, though. We've had some interesting data come out as well this week, the likes of vehicle sales, even PMI data, of course, pointing to perhaps what could be a better scenario for South Africa's economy. But that growth figure will be quite synonymous and quite key as well moving on. Well, the market thus far up 0.75% there for the all share, well above that 59,000 point mark. Will it stay stay there for the day. We'll certainly see. But for now, that is where the buck stops. That was me and myself, and Warwick Lucas there from Galileo Capital.